Good evening, and thanks for joining us. I'm SKL. Today we're diving into a story shaking the heart of American manufacturing, Detroit Motor City, now at the center of a global trade war. President Trump's new tariffs on China are colliding with decades of global supply chains, and the impact is hitting American jobs, automakers, and your wallet. The big question: can Detroit untangle itself from its reliance on China and global suppliers? We'll break down the numbers, talk to experts, and map out the choices facing automakers, workers, and consumers. From sticker shock to battery bets and reshoring, this is a high-stakes moment for Detroit and the American economy. Let's get started. Detroit has powered America's auto industry for over a century. Ford, GM, and Stellantis aren't just companies, they're the backbone of entire communities. But today's cars are built from parts sourced worldwide: wiring from Mexico, chips from Taiwan, batteries from China. Tariffs are now disrupting this global system, aiming to bring jobs back but throwing supply chains into chaos. Detroit faces political pressure to reshore, economic pressure to keep prices low, and the challenge of untangling global connections. The stakes: higher prices, new risks, and the future of Motor City itself. Let's see how the first blow landed. The 2025 tariff surge hit Detroit like a thunderclap. Executives scrambled to assess the damage. How many parts came from China? And what would the new costs be? The answer: billions in unexpected expenses, not just on finished cars, but on thousands of components essential to U.S. assembly lines. Even a 25% tariff on these parts could wipe out profits or turn winners into losers overnight. Earnings reports reflected the pain: profit warnings, stock drops, and nervous calls with Wall Street. Legal teams rushed to file for tariff exemptions, but the process was slow and uncertain. The unpredictability froze investment and forced automakers to delay major projects. Suppliers, especially smaller ones, faced existential threats as costs were pushed down the chain. Some family-owned shops couldn't absorb the hit, risking a domino effect of closures. The first blow wasn't just financial, it was a shock to the entire system, from boardrooms to factory floors. Automakers and suppliers had to rethink costs, risks, and survival strategies overnight. The adaptation process was painful and immediate. Detroit's resilience was about to be tested like never before. The shock was over. Now came the hard work of survival. How would Detroit respond? Let's look at the next moves. Detroit's answer to tariffs was a strategic pivot, rethinking where and how cars are made. Retooling factories became urgent, swapping out machinery to use new tariff-free components. The bigger move: reshoring. Automakers announced billions in investments to expand or build U.S. factories, aiming to make key parts domestically. The biggest gamble? Batteries. Electric vehicles are the future, but China dominates the battery supply chain, from minerals to finished cells. Tariffs exposed this vulnerability, threatening to make American EVs uncompetitive. Detroit responded with joint ventures and new gigafactories across the Midwest and South, aiming to build batteries at home. Automakers even invested in mining operations in Canada, Australia, and Chile to secure raw materials. But building a domestic supply chain takes years, and the short-term pain was real. The shift from just-in-time to just-in-case manufacturing marked a radical change. The goal: resilience over pure cost efficiency. Detroit's factory floors are being transformed to weather future trade storms. The stakes: survival in a new era. Can Detroit build a secure, cost-stable future? The next challenge: how these changes hit buyers and dealers. Let's head to the showroom. The impact of tariffs and supply chain chaos landed squarely on the dealership floor. Automakers faced a choice: absorb higher costs or pass them to consumers. Inevitably, prices rose. MSRPs climbed across entire lineups. Trucks that cost $50,000 last year, now listed at $52,000 or more. For many families, that increase put new cars out of reach. Automakers shifted to creative incentives: low-interest financing, more leasing options, to soften the blow. The used car market boomed as buyers sought value, driving up prices for late-model vehicles. New car buyers opted for lower trim levels, prioritizing affordability over luxury features. Brand loyalty was tested as shoppers cross-shopped for the best deal. Dealers became financial consultants, helping buyers navigate rebates, financing, and leasing to fit tighter budgets. Inventory management was critical. Dealers avoided stocking too many high-priced models. The entire rhythm of the retail auto business changed. The pressure on buyers and dealers was intense. The market was forced to adapt fast. The next question: could Detroit find new lifelines in North America? Let's look north to Canada. How did Canada's resources and China's grip shape the next phase? Here's what happened. As Detroit scrambled to rebuild supply chains, Canada emerged as a crucial partner. Canada's wealth of critical minerals, nickel, cobalt, graphite, lithium, made it vital for North American battery production. U.S. automakers invested heavily in Canadian mining and processing, aiming for a mines-to-mobility supply chain. The Canadian government offered incentives, and cities like Windsor saw a manufacturing renaissance. But China's dominance in mineral refining remained a major bottleneck. Over 80% of global capacity is Chinese. Even Canadian-sourced lithium often had to be shipped to China for processing before returning to North America. Breaking this dependency meant building a new refining industry from scratch, a massive, years-long challenge. China's influence extended beyond minerals, dominating many other auto components. Even as Detroit reshored, Chinese content remained hidden in many made-in-America cars. Canada offered leverage, but China's grip was hard to break. The race was on to build North American capabilities before geopolitical tensions cut off supply. Detroit's future depended on how fast it could close this gap. The next 2 years would be decisive. What would this mean for jobs, prices, and the cars we drive? Let's look ahead. The next 24 months will be a tug-of-war for Detroit, between job creation and job loss, higher prices, and shrinking demand. New battery plants could create high-tech jobs, but automation may not replace lost jobs. The United Auto Workers is fighting for good-paying, unionized jobs. Vehicle prices will stay high as automakers retool and source domestically. Some buyers will stretch loan terms, others will exit the market. The tipping point: how much will consumers pay for a made-in-America car? Automakers will focus on high-margin trucks and SUVs. The EV race continues, but affordable electric cars may remain elusive. Profitable trucks will fund the shift to domestic EVs. The next 2 years will reveal who adapts and who falls behind. Detroit's choices now will echo for a generation. The stakes: jobs, prices, and the future of American cars. The verdict is still out. Let's sum up what's at stake. Detroit stands at a historic crossroads. The trade war and tariffs have forced a reckoning with the risks of global supply chains. The Big Three face a choice: invest billions to reshore and build a secure North American supply chain, or hedge by shifting sourcing to other low-cost countries. The first path is costly but promises long-term resilience. The second is cheaper but leaves Detroit exposed to future shocks. Flexibility is key. Success will depend on managing multiple strategies, adjusting product mix, and making bold bets on domestic production. There's no easy answer. Untangling from China is like complex surgery: necessary, risky, and sure to leave scars. The next few years will test Detroit's resolve and ingenuity. The decisions made now will shape America's economic security and millions of livelihoods. The conversation between automakers and consumers has never mattered more. Can Detroit truly de-risk from China, or is that wishful thinking? Will buyers accept higher prices, or turn to used cars and leasing? Let us know your thoughts in the comments below. Detroit is being forced to reinvent itself in the most dramatic way in generations. The choices made now in Washington, Detroit, and Beijing will set the course for decades. This is about more than car prices. It's about jobs, industrial capacity, and economic security. The road ahead will be bumpy, but the journey is unavoidable. We've presented the analysis. Now we want to hear from you. Drop your opinions and predictions in the comments. Thanks for watching. We'll see you next time. Subscribe to the channel for more updates.